Okay, welcome to Practice Problems for Chapter 15b. Let's jump right in here. So we're trying to do two things here in this chapter. One is we're going to value a steady state entity for all financial stakeholders where we assume we're going to own it. The team is going to be involved forever till hell freezes over. And when we have something like that, we call it a perpetuity situation. So specifically, what we've got here is company X. It's profitable, debt-free as of right now, and it's assumed to be operating in steady state forever. No growing, no shrinking, same revenue every year, same net income every year, et cetera, et cetera. So we've got a team of debt and equity investors considering to buy it, and if we do buy it, we're going to restructure its debt corresponding to what we think would be the optimum WACC, the optimum cost of capital, which would, of course, maximize the NPV for the team. So the asking price of the firm stock is $200 million. It is debt-free, so we don't have to worry about also repaying the principal on any loans outstanding, because there aren't any loans outstanding. And based on prior work, our team believes that an optimum capital structure for this firm would be a ratio of debt to capitalization, D over D plus E, or debt to enterprise value, if we want to think about it in market value terms, D over D plus E of 60%. So if we proceed with the transaction, what's going to happen is that equity investors are going to pay, this works out to 40% of the 200 million purchase price, and that's going to come from their own funds. So if it was a hedge fund, it would be from their own funds, private equity firm from their own internal funds. And then the debt folks are going to get involved because Company X would take out a long-term loan at the moment of closing, which is going to be provided by the debt investors on the team, and that's going to pay the remaining portion of the 200 million required to get 100% ownership of the firm. And then the firm is going to stay in its steady state with its new capital structure. It'll have a new capital structure forever. And the equity investors will enjoy that. And the debt investors will just keep renewing the loan in the same terms again for until the end of time. So what we want to find here is the team's estimate of Company X's enterprise value, right? That's going to be separate than the market's estimate. And we're going to look at the NPV of the project for the entire team and see if it's a good project for the team. So along the way, we've got a bunch of constants here. We've got our risk-free rate, our market rate, our beta with no debt, our beta as recapitalized, and you don't have to worry about all this because I've already taken care of it for us. I've used this leveraged beta to help get the cost of equity capital and all that jazz. So the total capitalization is going to be 200 million, right? Because that's what we have to pay to get control of the company. And the new debt to capitalization or debt to enterprise value ratio is going to move from 0%, because they don't have any debt now, to 60%. And that's given to us. So all we need to do here is determine the D portion required to buy this firm and the E portion required to buy this firm, okay? And we know that the debt portion is 60% of 200, so we'll put that in here. Okay, and that's 120, and then the equity portion has to be 200 minus what is going to be paid out of the new loan the company is taking out, and that's 80 million. So the equity team is going to have to cough up 80 million of their own funds, and the lending team is actually going to have to cough up 120 million of its own funds to lend to the company at T equal 0. And again, the company uses those proceeds. It gets the loan, it immediately turns around and pays the previous owners that 120. This 80 goes to the previous owners. Then the previous owners are paid off completely. They don't own any more shares and they walk away. All right, so we have some more key information here. The debt interest rate has climbed as expected. Once the company is levered, it's riskier. So we expect that the interest rate on its debt would increase. So this 7.75% represents the interest that would be charged for the company if it had took out a very, very small loan at a time when it starts out with zero debt. And this 9% represents the interest rate that the company is going to have on this loan when it's levered by 60%. So that's all making sense. Income tax rate isn't going to change. The IRS doesn't care what your capitalization is. So the income tax rate is the same. And the cost of equity capital has gone up as we expect here again, because as the company gets more levered, it's more dangerous for debt investors and also for equity investors. And then I've computed for us, you guys know how to do this already, so in this case I've already computed for us our weighted average cost of capital. Okay, so what we need to do to solve this is get our free cash flows. I'd like us to get two things here. Hopefully that's what I asked for. Yep. I'd like us to compute the team's estimate of the company's enterprise value and then the NPV. And of course, along the way to getting the NPV, we're going to have to compare the team's estimate of enterprise value to Mr. Market's view of enterprise value. Okay, so to get the team's view of the enterprise value, what we're going to have to do is get the present value of all the future cash flows that are available to the team, right? And that's going to be the team's estimate of enterprise value. And we know our formula for that. It's going to be NOPAT minus changes in working capital plus depreciation minus CapEx minus any extraneous changes to the debt. So let's start by getting our NOPAT. So all the initial stuff is given to us here. None of this changes down to EBIT because that has nothing to do with how the company is financed, and the tax on EBIT is equal to the EBIT times the tax rate. And our tax rate up here is 35%. So we put that in and we get our 9.45. And EBIT minus tax on EBIT is equal to NOPAT, or net operating profit after tax. So let's go ahead and put that in. Okay, so that's our net operating profit after tax. And in general, to get to our free cash flow, we have to subtract annual changes in working capital, add back depreciation, subtract CapEx, and any extraneous changes in debt that happen in some weird way get included in there. And in this case, of course, the changing working capital is zero because the company is not growing or shrinking, so it doesn't have to increase its inventory, decrease its inventory, or make any changes to any other working capital accounts. So depreciation does get added back because we're trying to get from this number to cash. So we see this depreciation hidden in there. We know that's a non-cash expense. So that's 45. But then, wait a second, if the company is in steady state forever, its CapEx will match its depreciation. The amount it has to spend on maintaining its equipment should be exactly the same as the measured amount of wear on its equipment. So we have plus 45 minus 45, which in most circles is equal to zero. So in this case, the free cash flow available to all the financial stakeholders is equal to the NOPAT. And that's going to be true for any steady state kind of firm. Okay, so with that in our pocket, we're ready to jump down and get our team's estimate of enterprise value here. So in general, the enterprise value estimate is the present value of all the cash flows available to the entire team, debt investors and equity investors, measured for as long as the team is involved with this entity. So in this case, the team is involved forever, and that means we can use our perpetuity formula to get the present value. So the present value of all the future cash flows running out until hell freezes over, until the end of time for this entity, is just our free cash flow for a single year divided by the weighted average cost of capital. So that's going to be our 17.5 divided by up here. Here's our weighted average cost of capital. Okay, and so that's 229.77. And again, that's the team's estimate of enterprise value. What is available in present value terms from all the free cash flows from this entity available to debt holders and stockholders for as long as they're involved in this project. Okay, so now we're ready to go ahead and get an NPV for this project. So we have almost all the cash flows for this project. The only one that we're missing is the total amount of money that needs to be coughed up at t equals 0 to make the project happen, which in this case is simply the 200 million that it's going to cost to buy 100% of the stock from the existing owners. If the company already had some debt, to get control of everything with the company, we would have to buy all of the equity and we would have to repay the principal on the existing debt because we assume the current existing owners of the debt would exercise their change of control put. So it's a little simpler here for us. Okay, so this is the market's estimate of the enterprise value, right? It's the total amount required to buy all the shares of stock and refinance the existing debt, which in this case is equal to 0. And now the NPV of this project for our team is, again, the present value of every stinking cash flow for them for this project, which is the present value of what the firm is going to make available to them going out till the end of time, minus their negative cash flow at t equal 0. So that's going to be equal to what they get in present value terms, right, minus what they have to pay out in present value terms, and that's 29.77. So also, of course, we always want to think about what is the meaning of this, and in this case, NPV greater than 0 implies that our model says go for it. Okay, and I want to stress model here because in the real world, there are other considerations. You want to talk to the existing CFO. You really want to do a very careful market study. It's almost never true that a firm is going to stay in steady state forever. So I would think seriously about the market and the macroeconomy and how close to truthful that assumption could be. So here is a set of bonus tips for some of the homework problems. So in one of the homework problems, you're going to see that it's not starting out as a debt-free firm. It's capitalized with debt and equity. So in this case, to get control of the firm, you're going to have to buy all this stock, but then you always need to assume that you have to refinance the debt. So in other words, this debt principal that's owed, that has to be repaid to the lender as part of the team's taking control of this entity. So the total amount that the team is going to have to cough up to take control of this entity is going to be 200. Going to have to buy all the shares of stock and refinance the debt. The current lender is going to exercise their change of control put, saying if there is a change in ownership, then all the debt becomes due and payable immediately. So in this case, we're starting with a firm with a leverage ratio of 50%, and your team believes that the optimum leverage for the firm is actually a little bit less than that, 40%. Other than that, really nothing changes in the problem. You have to cough up the 200 million, and then you're going to change that from 100 equity, 100 debt to 40% of that 200 is going to be debt, and 60% is going to be equity. And then you go ahead and solve the problem the way that we've been solving things before. Okay, I hope that little set of hints is helpful for you. Okay, so now let's do another problem where we're looking at the buy, manage, sell model. Again, we want value for all stakeholders, which is enterprise value. We'll get our estimate of enterprise value, compare that to Mr. Markets, et cetera, et cetera, et cetera. But the buy, manage, sell model is more realistic than the perpetuity model because most entities are not going to be around until the end of time. But if we're, for example, a private equity team with equity investors and lenders, we can buy the company, control it, its equity and its debt for a small number of years, resell it. That's a lot more realistic and a lot easier to predict. So let's go ahead and check out one of these types of problems. So now we've got Company Zebra, a profitable, debt-free entity, and it's operating in steady state forever. That's a dubious assumption, but it's not going to worry us too much for reasons we're about to see. And we've got an economy in recession, and Zebra stock is suffering a classic throw out the baby with the bathwater situation, where even though it's operating in steady state, it has not been affected by the recession. Because it's a recession, the price of everybody's stock has gone down. So our team wants to take advantage of that. So we want to buy it, even though it's performing really well. We want to buy it when its price is low, hang on to it until after the recession, and then sell it for a higher price and get a wonderful profit. So the asking price today for all of the firm stock is 100 million. And remember, there is no debt outstanding right now. It's a debt-free entity. So this is all we have to worry about to take control of the firm. And it tells us to the PE that corresponds to whatever. Someone on the team has already done for us an optimal capital structure analysis, and they believe, and the team agrees, that the optimal debt to enterprise value or debt to capitalization value ratio for the firm would be 45%. So that means 45% of the capitalization comes from debt and 55% comes from equity. Okay, and if the team goes ahead with this, what's going to happen is that 45% or 45 million of this price is going to be obtained by the company getting a loan of $45 million and immediately turning those proceeds over to the prior owners. That 45 million would come from the debt folks on our team, and then 55 million is going to have to come from the equity folks, which will be paid directly to the prior owners. So they'd get all of the shares and they'd burn 45% of those shares to make the share count go down. Okay, and then the equity folks are going to operate the company once they bought it for 2 years, and they're thinking the recession will be well over and prices will be recovered by then. And at the end of those 2 years, they're going to resell all of the stock, and shouldn't say loan there, the loan will be terminated, i.e. the principal will be repaid. So that they think that, remember, after they do this with the recapitalization, they only paid 55 million, right? The other 45 came from a loan. So they think that all the shares can be sold for 66 million. So that would give them an 11 million profit for the equity holders in 2 years. So that's how they think that this is going to shake out. And what should we find? Let's find our estimate of the company's enterprise value, and then we'll get the NPV of this project for the whole team. And that's going to come by subtracting the total price required to take over control of this company from what we believe is our best estimate of its enterprise value, coming from the present value of all the cash flows we expect to get out of this project. Okay, so what else do we have? We have a bunch of given constants, and once again, I've done most of the heavy lifting for us here, computing RE and our WACC from beta leverage using CAPM for RE, all that jazz. And so our financing structure is 45% of the capitalization, once the team is controlling the firm, wants to be coming from debt, and the rest wants to be coming from equity. So that means that the loan the firm has to take out is equal to 45% of the total amount needed to take over the firm, and the equity folks in the team are going to have to come up with the rest of the takeover control price of 55 million. And then I've got our key rates computed for us. Income tax rate doesn't change as a function of your capitalization. The IRS does not care about that. So we're taking the firm from no debt to some debt. So the interest rate on debt should be expected to increase. Again, the 7% represents the expected amount of interest the company would have to pay in its existing state if it took out a very small loan. So it would go from zero debt to a very small amount of debt. Over here, it's got 45% of its capitalization from debt. So the interest rate is, of course, higher. Okay. Same thing with RE. When we go from an unlevered firm to a levered firm, the risk goes up for equity investors as well as debt investors. And I've computed here our weighted average cost of capital for us. And you can see what I've done here. I've used our formula for weighted average cost of capital, 1 times the tax rate times our weight of debt times our debt interest plus our weight of equity times our equity cost of capital. So what we're going to need to estimate the enterprise value in this case is 2 things. We need to know the free cash flows we're going to get from year 1 of operating this company and year 2 of operating this company. And then we also need to know the free cash flow that we're going to get from selling the company at the end of year 2. So let's start with our operating free cash flow, which as always comes from our NOPAT minus delta working capital, et cetera, et cetera, et cetera. Okay, and we already have a partial income statement for this guy. And as was noted in the beginning of the problem, the company is operating in steady state. We don't know if it'll be forever, but we're only going to be involved for 2 years. So let's say it's a good assumption that the company will continue to operate in steady state for the next 2 years. So that means we don't have to compute 2 separate cash flows. Each of these cash flows available to equity holders and lenders is going to be the same for end of year 1 and end of year 2. So let's get to our NOPAT. We've got our EBIT here already, and to get NOPAT, we just need tax on EBIT. So let's say we've got our EBIT times our tax rate, which is up here at 35%. Okay, and that's 7. So now NOPAT is just equal to EBIT minus tax on EBIT, and that's 13. Again, with steady state, we're going to have no changes in working capital, and depreciation should be matching our CapEx. So our free cash flow to everybody should be equal to NOPAT. Okay, so now we're ready to value this entity, get our enterprise value, and get an NPV for the project. So the first thing I'd like to put down for us here is the amount that they're going to get on exit, which is going to be the amount they're going to get for selling 100% of the stock and then the loan principal repayment. So let's go up and grab their estimate of what they'll be able to sell all the stock for. And that is, here we go, 66 million. And we have to add to that the loan principal repayment. So the loan amount, the debt amount is going to be 45. So we add those 2 together, and total for the team, shareholders and debt holders, they anticipate getting 111 back at the end of 2 years. So now we're ready to get the team's estimate of the enterprise value, which is the present value of all the future cash flows they expect to get from the firm while they're involved with it. So I've got it worked out for us here. That's going to be 2 years of operating free cash flows, each discounted back by the appropriate number of years, and then that total resale price of stock plus debt discounted back again by 2 years, everything discounted back, of course, with weighted average cost of capital, or WACC. So we need our free cash flow times 1 over 1 plus our WACC, which is up here. They're changing the capital structure, so we expect that WACC to change. And there's for our first free cash flow plus 1 over 1 plus E50 raised to the 2. Okay, and then finally, we need to include here our 111 and discount that back by 2 years. And that's 118.41, and that seems to make some sense. So that's a team's estimate of the enterprise value. Now we want to get the NPV for the project, so we have to consider now every stinking cash flow for this project, including any cash flows at t equals 0, which is, of course, the amount of money the team has to put out to get 100% of the shares and refinance the debt. And that's equal to our 100. And that's looking good. And let's maybe make that negative. And now we can get our NPV, which is 18.4 and change, and that's greater than 0. So this implies the model says go for it. As usual, in the real world, we want to do more than just our numerical modeling. But in terms of our model, enterprise value is 118.4, and our NPV for this project for the whole team is greater than 0. So let's go for it. Okay, that's it.